Welcome. You are listening to Purpose-Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose-Driven Wealth. I'm your host, Mo Bina. Today on the show, we have John Green. John is a co-founder of Nada, where he served as CEO since its inception. He is also the managing partner of City Funds. John, welcome to the show.
Thanks, Mo. Thanks for having me. Excited to be here.
Yeah, thank you for coming on. John, let's get started. Can you please kind of talk about your background and how it came to you founding Nada and City Funds?
Yeah, happy to do so. You know, I think my background and story kind of fits twofold. In my late teens, early 20s, I ended up playing music in a punk rock band with some friends, and we started taking it very serious. That was what we were doing, and we ended up getting signed by a record label and did that full time. We did touring, across the country, and we released 2 albums across 4 years. And that whole kind of non-conformist, really, that creator, the way that I participated in the music space was a lot of vulnerability, because I go back and listen to it as, we're a solid 3 out of 5. It's not, not anything really amazing, but I took it very serious. I was trying very hard. So, that experience really created this, what does it take to build something, get yourself out there? And, again, a bit of a non-conformist, like the punk rocker. And I ended up working in the mortgage industry, first in sales, and for mortgage banking after this. So at some point, music and that whole journey just kind of reached an end point naturally. And I got to where I was working for WAMU, if you knew of WAMU, and then I was there for a while. And during the takeover of JP Morgan, I transitioned to JP Morgan, and I got out of a sales role. And then kind of the short of it here is I spent 10 years plus in the financial services industry, mainly mortgage banking, independent mortgage bankers, doing risk control, process design, to where towards the end, strategy and innovation. My job was go find new joint ventures to get new business, go find new technology to create efficiencies, really all these different kind of entrepreneurship type roles, but in that space. So I've got this punk rocker nonconformist with this structured financial strategist that really kind of came together perfectly, that gave me the insights and maybe a bit of the crazy or vulnerability or whatever you want to categorically say punk rocker does to someone, to say, I am so amazed consistently how real estate, in particular residential real estate, that this giant asset class that touches our lives on a daily basis, is still so incredibly specialized and privatized, meaning specialty in the language. Who understands this? What means of education is there of it? Is there really a total absence of it? And then privatized, meaning those that participate and get the most value out of the economic benefits of real estate are usually very small, private, exclusive circles. And I fundamentally wanted to change that. Again, maybe you can correlate that to the punk rocker nonconformist. And I said, okay, this isn't right. I want to come together and create something to where, from language to financial products to really business model entirely, build something that's far more inclusive and far more sustainable, and not so subject to interest rate markets and stuff that you really don't have any direct control over. And all that kind of culminated to give me the motivation and everything to build Nada.
Nice. And can you get into essentially Nada, and then also the investment platform, City Funds, and kind of get into the details of what it encompasses?
Yeah. So Nada is really a wealth tech platform. So we serve 2 sides of the market, but I'm going to focus first on the real estate investment funds that we issue and manage. Are called City Funds. So a City Fund is an index-like fund for a single city. We have Austin City Fund, Miami City Fund, Tampa, Dallas, etc. Each of these funds that we're issuing contain a basket of assets within that specific metro. So the purpose and design behind this goes back into the accessibility, really, in again, language, very simple language, very simple concept. And so I'll speak to really the spirit of it, and I'll go into the nuts and bolts of really what it is. But the spirit of it is, most people, when they get into investing, they're going to invest in stocks. They're going to go, maybe they download Robinhood, E-Trade, whatever it is they get into, and maybe they have an Apple computer, or maybe they like drinking Starbucks. And so they are probably going to invest in something that they've experienced themselves. They're going to invest in Starbucks, they're going to invest in Apple, Tesla, if they drive a Tesla, et cetera. And so by creating a real estate fund that has a very similar concept, maybe they went to school in Austin, maybe they just vacationed in Miami, whatever it may be, it's something that they can see and experience. Maybe they're following the news. Messi just moved to Miami to join the MLS team there. It's going to be a very big move, could be an economic lift there. Just anecdotally, if you feel some connection to that, you can experience it, and it can be your first way to really get into owning and realizing the economic benefit of real estate. It makes it far more simple and accessible in just that presentation. And what's most unique about it is the way we're able to reach a high volume of assets dispersed across the city is our unique asset that we're actually originating. So Nada also operates a licensed mortgage brokerage, and through that we do traditional debt products. But the thing I want to focus on is we do a home equity investment product. And what we do is, a homeowner, let's just take Austin for example, the valuations of homes there have skyrocketed. A young family could have bought a home there 2 or 3 years ago. They love it. They don't want to move out of Austin. Interest rates are so high. You don't want to, try to get a new home. But what could they be feeling? And what do we see a lot is they could have in Texas in particular, like what goes up with valuation is your property taxes at a pretty high rate. And so there's a material cash flow impact there that someone could have without wanting to sell their home. Yet at the same time, there's unprecedented equity in homes. There's a substantial amount of people that are equity rich. It's $27 trillion in homeowner equity today that is effectively an illiquid, sector of the residential real estate market. So by us taking in originating a home equity investment, we're able to go to that homeowner and say, okay, the position of equity you own is, simple math there. Let's say it's 100,000. So we're going to say, if you want to cash out some of that, we'll make an investment into your home, and we'll buy. You want to get 50,000, we'll buy 50,000. But we're going to get in exchange 50% of your home's future value above what it's at today, because we're buying 50% of your current stake. And so because of that benefit we're delivering to someone, that liquidity, no debt, no credit impact, we can contractually create an investment for our funds that is primarily two key things. One is it's in the money. Most simply stated, it is contractually worth more day one than what we are paying for it. And then two, because these are owner-occupied homes, the owner retains, carry forward similar covenants to ownership rights and responsibilities, and the majority equity upside. So you have effectively a self-managed asset with an owner that is inherently aligned with the interests of, ourselves and our investors, and that being like, hey, we want this home to create, long-term value.
Wow. So if I understand correctly, essentially what we're talking about then is owners get to do, they get to cash out, they get to take equity out without having to do a refinance. Because a lot of homeowners, over the last few years, you were able to lock in extremely low interest rates. And so people that were able to get in at a 3% or even sub 3% mortgage, the last thing they want to do is refinance to take out equity and end up at a 5 or 6% loan. So this provides a benefit for them, right, of being able to take out cash or take out some of that equity. And then at the same time, they don't need to refinance. They don't need to change their mortgage rate is unaffected. And at the same time, like you said, you're buying at a discount. Typically, what type of discount are you purchasing or getting these these fractional stakes?
Yeah, I mean, there's a few factors that goes into it. You can effectively correlate it to the pricing element here. I'll give you some of the marquees. Your traditional owner-occupied primary residence, detached home, it's going to have a 10% discount to the appraised value of it. And so then based on their amount of leverage, their equity stake, it kind of moves up and down. But that's the discount face value. That's kind of your A grade, scenario. If we will extend to a townhome, we won't do condos. There's too much market volatility, just considering the domino effects in that space. but like a townhome face value, you get a townhome, it's a 15% discount because it carries more risk and volatility in terms of the really, how well it's going to hold its value. Similarly, if it's an investment property type, not a primary residence, we're going to go 15% discount. But there's nuances within certain compensating factors based on credit and collateral that kind of tiers that in between.
And so from an investor point of view, essentially an investor would be able to invest in a fund that is city specific and that has a basket of real estate assets within it. And so they're able to essentially acquire or take a position in fractional ownership of essentially, are we talking exclusively or are we talking mainly owner occupied homes?
It is predominantly, not exclusively. We do a mix of investment properties that are pretty much at 15% cap in terms of portfolio within each city. None of them are at 15 currently, but we would go up to that.
Gotcha. Okay. And then how do you identify like which cities to invest in? Or actually, maybe I should first start by asking, which cities do you currently have a city fund designated for? And then how do you identify which cities perhaps moving forward that you're going to be adding?
Yeah, so today we have active raising and operating Dallas, Austin, Miami, and Tampa. And a couple of months, we're going to announce and release Denver. Because these are private real estate funds that we've worked with the SEC and FINRA to get qualified under the Regulation A exemption, which means we're able to offer them direct to retail investors, accredited or not. So it allows us to really increase, again, the accessibility of ownership, in this case, from a financial product standpoint. So when I'm saying these new cities, these are cities that we've already structured and obtained SEC qualification to make public. So it's Denver, it's LA, it's Phoenix, Nashville, and really these are the ones that are on the map for the next year plus. And we've got a lot more MSAs, and because it is by the metro area, so identified by the city, because typically it's just how people correlate that, but we're more diversified within each. We have 32 that we plan to release over the long term, but these are the near term. So your other question, like how do we look at a city? We do look at like what's happening with movement. So why did we start with the ones we have now? There's a tremendous amount of movement from really the larger coastal cities, that being East Coast, West Coast, to these, like Austin in particular was huge. Dallas is consistently the same. We're seeing very similar in Tampa and Miami. So there is that movement into like population economic growth that you can see and identify there. But there is also this marketability of the city. I mean, that's kind of how we identify with what a location is. If we think real estate, we think location. If we think location, one of the easiest ways to identify that is this city. A city has a certain meaning, feeling to it. So we do think about that. That's kind of this ethos element of it. But another thing that we really look at that would disqualify something like, let's say, San Francisco. It's a great market, very cool, very, very marketable. But the housing stock, the units there are very nuanced. And so in order to reach like an index-like representation of that city would be much harder than say, a Phoenix, where there is more standardized housing, if you will, more PUDs, more planned unit developments, more easier for us to create less volatility. And so as we build greater data models and better senses of how to do that in these more nuanced markets, we'll expand to those. But right now we're looking for I guess kind of the former there.
Absolutely. And when you set up a particular or a specific city fund, whether it be for Dallas or in Austin, is there a minimum number or a number of real estate assets that you look to put into that particular fund? And then once you do that, do you continue to add to that number?
Yeah, I'd say 200 unit count is really so where we consider it a pretty well diversified fund. But these are evergreen funds, so we are always raising capital. We do have anyone can invest in these funds directly from our site, our app, City Funds by Data. And that's primary marketing that we have with the broker dealers, where you can buy primary securities at current share price, NAV. But we also have an SEC registered ATS, a trading platform. So in trade windows, which, every quarter, there'll be a week for trade to where shareholders can sell. So there's this momentary period where someone wants to get liquidity and sell at the current share price. They have optionality to sell to other investors, and then we're back to raising new money. And so because they're evergreen, we're trying to get them up. And because each of these funds, they're series LLCs, so they're independent. There's one parent, City Funds, one LLC, and then underneath that, there's Series Austin of, Series Dallas of, et cetera. That way, it's a very repeatable construct, at least for the SEC and FINRA's qualification process and our legal team, to where now we really just stamp out new cities. Where we want to grow each city is to, right now, the market would say maybe 20, 25 million in, effective AUM that is sizable to go to switching from a direct to consumer platform to an investor relations and going with a publicly listed vehicle. But we do want to get each of these to where they are publicly listed and broadcast, across multiple broker dealers and available in any stockbroker app that anyone may want to invest in. And that's, the scaling strategy.
And within each city fund, the way it's been set up is that's available to all types of investors, not just accredited, but anyone can invest in a particular city fund. And how does that work, like on your investment platform? Like, are there particular minimums that need to be invested? Because it sounds like you can work with all investors. So are there particular like investment minimums that are required?
Yeah. So under the SEC Regulation A, we can accept, again, not accredited investors, and really we can dictate what the minimum is that we believe is feasible. And currently we're operating at a $100 minimum, so that first we want to be the first introduction to real estate investing. And for a lot of people, taking your first investment of $100 is a pretty high threshold, but not so high that it's so exclusive. And then with the way we see it as an operator is that it is on us to demonstrate the value of this investment and our management of it to get them to increase their investment. So our average, we call them, the online retail, kind of the scattered retail investor, is actually investing closer to $1,500, and in at least pretty much 75% of them are in at least 3 of the cities that we have actively offered. So we're seeing that constant. You want to invest in more, some recurring investments, et cetera, but that entry point is the $100.
I see. And so basically an investor, if they wanted to, because you said the average person is probably putting in about $1,500. Now, they could essentially take that $1,500 and they can split it, amongst multiple cities, right? They could take $500, $300, whatever happens to be, put it into a Dallas, an Austin, a Tampa, Miami, and then some of the other cities that you talked about.
Mm-hmm.
And at that point, essentially get like geographic diversification, I guess, right?
Absolutely. Absolutely. Yeah.
They're not getting, they're not susceptible to, let's say, a downturn in San Francisco and LA, whereas maybe Denver isn't experiencing such a downturn, when there's a slowdown in the residential real estate market. Because, there's been a number of cities over the last 6 to 12 months that have experienced, price decreases, and others have not. So I guess for a savvy investor who kind of realizes that and wants to get that type of diversification, this type of the way that you've structured your actual fund at the city level allows for that to take place.
It does, yes. It really pierces that veil of, a traditional private real estate fund has this really get to know and trust the experts behind it. And, I think that's great if you have that type of relationship. In this case, it really allows the individual to say, I have a sense, or publicly I can see this city is doing this, and it gives them a little bit more of an active control in it that way. All the same, like we have a team of people that have managed and been involved with real estate and real estate investing for years, and so we're very actively managing it. But it makes that decision, to your point, something that is intuitive and then thematic like that. And I'll riff on this real quick. But like Austin had this really massive kind of COVID peak, if you will, where sell prices from peak to now are still down in that market 10%, peak year over year. That peak is a bit of a false peak, but because of the downside protection that we put into our investments, we were making investments during the peak, but we had, enough downside protection to where we wrote it out. And so now someone is seeing Austin and they're saying, okay, now that market is stabilized because we are consistently deploying capital and originating new investments. It's now, even though it's still down year over year, it creates an investment opportunity because, we can get in at better prices.
Yeah, well said. And for what is kind of like the typical period of time that you project you'll have let's say an equity stake in a particular piece of property. So let's say that someone basically says, hey, I want to take out equity in my home, and then now you've got an equity stake in that home. What if that homeowner, stays put for the next 5, 7, or 10 years or more? Are you just carrying forward that equity stake? And if so, like how far or how long into the future do you think an average would be in terms of holding that equity moving forward?
Yeah, the equity investment contracts are 10-year contracts. So, you have a 10-year agreement to reach a settlement free payment of our interest. There is that. But the most common event is the sale of the property. And if my background is mortgage finance, and I spend a lot of time in capital markets and a lot of time with portfolio management, portfolio retention. And so a typical servicing portfolio retention has, forever and ever been that a typical homeowner is doing a primary refinance or moving their, out of their home into a new home, or moving period, just that home is exiting every 4 to 5 years. And so it follows the same trend line where there has been, there are at least 5 other originators of this asset class. Morningstar actually just last week did a framework for a rated securitization of the home equity investment. It said there is far more structure happening here in this space. And all that to say that there is more market standards on what are the conditional prepayment rates and et cetera. And that's around that 22% that everyone's seeing. And we're seeing the same on our portfolio, even though we're seasoned, only really a year and a half. We've turned over, I think we're at 14% of our investments thus far have already paid out. And in the current state, as you might imagine, these are all sales because rates are not favorable towards refinances.
Yeah, of course, like we talked about earlier, refinancing right now for a lot of people, for probably the vast majority of homeowners out there, doesn't make sense. So how can people find out more about City Funds?
Yeah, so we have a website that we try to put everything out there. We ourselves are very much like we are in the public. We build in the public, so we're very accessible. But that website is NADA, N-A-D-A, you see behind me, .co. So nada.co. And that'll give everyone a lot of information. And then for anyone that wants to get right into the app to know how to invest and own a part of these cities that they have experience, it's City Funds by NADA, and they can download that in the Apple's iOS store or the Google Android app store. So fully available to everyone.
Okay, great. John, thank you for coming on to the show today.
Oh, thanks for having me, Mo. I really appreciate it.
Yeah, thank you for sharing your insights with the audience. And that's all for today. And thank you, everyone, for tuning in. Until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.